This is a long and roundabout way for me of saying the people who have money still have money. They're not in recession. The people who don't are struggling. And we've seen, they say that, inflation ran at 8% for 2 years or whatever the rounded number is. We know that it was more than that. CPI is designed to underestimate inflation for reasons that favors the government.
Welcome back to Soar Financially, everybody. Thank you so much for joining us. My name is Kai Hoffman. I'm the CEO of the Soar Financial Group and the @JRMining guy on Twitter. We have a doozy lined up for you today because we're joined by a trader. And when I interview traders, I tend to speed up my questioning, and my guests usually speak fairly fast as well because that's how they make money. You got to be fast. You got to act fast. Quick reminder, YouTube has there's a little wheel there. You can change the speed of the playback. If we're too fast for you, slow it down to 0.75 and you should be okay, right? So just a reminder. We have a ton of topics to talk about. Last night, the Fed released their bank stress results. Really interesting stuff. We got to talk about the Treasury bill issuance that nobody seems to be talking about because I can't barely find any newspaper articles about it. And of course, we got to challenge Jim on his commodity calls that he made on our program last December. Here's where we stand there. If you all remember, copper was his top pick. He was highly allocated to it, or uncomfortably long, as he said in our conversation. So let me bring Jim on the screen. Jim, great to have you on. You're the managing partner over at TGM Institutional Services and also a fellow podcast host over at the Future Edge podcast. It's great to have you on. Thanks so much for joining us.
Thank you for having me, Kai. I think it's hysterical that you put it out how you can slow down Jim Iuorio talking. I mean, as my wife always says, you make people nervous. I don't try to. It's just an abruptness.
No, it's like I've noticed it with traders, like Bubba Horowitz as well. Like we just flew through the conversation. And usually it's about 30 minutes to 40 minutes, traders 20, 25 minutes done, right? All topics covered. It's hilarious. Jim, you were on the program in December 22 pretty much at the end of the year. We did a bit of a recap and we tried to forecast a little bit. A lot has happened, but if I look at the commodity prices, even the dollar, for example, we're pretty much where we started late last year. Right? Catch us up quickly on the latest developments and why are we back to where we started?
Okay, so here's the things that I've been wrong about so far. Again, it's so funny, like on Twitter when someone calls me out for being wrong. Are you kidding? We're traders. We're wrong all the time. Here's what I've been wrong about so far, and here's what I still think I'm going to be right in the end too. What the metals market really, really wanted was the Fed to overdo it relatively quickly with their tightening cycle and then have to quickly respond by adding liquidity to the market. And remember, just 2 short months ago, that's what the Fed funds futures curve said was going to happen. That's what 2 versus 10 said was going to happen, which still says it's going to happen. But the Fed funds futures curve still says things are fine, and the Fed is not even necessarily going to, ease this year at all. Before, it used to say there was going to be 100 basis points of easing in 2023 and potentially 200 more in 2024. That's all changed. Now the numbers have been coming in good. What's really, really interesting is that the numbers have been coming in good and the inflation numbers have been coming in lower. So this is great for the soft landing scenario, but it's not what the metals market wanted. And that's why we've seen these trade-offs in gold, silver, and copper, which are 3 things I'm fairly heavily allocated to and still am. And in retrospect, there was some technical things I saw when the markets were kind of toppy that I should have hedged some of my positions. I didn't. I'm taking a little hot water on them, but I'm fine. Or taking a little water, whatever that expression is. You get it.
No, absolutely. Well, it's interesting because all the indicators beginning of the year said, okay, we're going to have a recession rather earlier than later. We're still waiting, right? The term Godot recession seems to be making rounds even in mainstream media based on a movie. I haven't seen it, so tough to comment, but apparently you just wait for somebody that never arrives. Right. And another term is the most anticipated recession in history. Everybody should be ready. Do you think everybody's ready? We had the bank stress test results last night come out.
Okay. So the bank stress tests, which I'm not, don't provide me with a ton of comfort, but they came out and they said everything's fine. I still think there's something nefarious about the way the federal government is treating the banking industry. And I think that they would love for people to gravitate toward the big banks. So to me, it almost seems a little bit nefarious that they say, yeah, the big banks are fine. Because remember when Janet Yellen spoke in front of Congress and was asked specifically, are you going to guarantee depositor that small and regional banks? She said, and that basically said, if your bank isn't systemically important, we don't give a care. And that startled some people. Now, she's since walked back on that, and they kind of implied that they're going to guarantee everybody. But those stress tests to me seem there's a little bit of a push toward banking with the bigger banks, particularly if you're a corporation, a small business that has, way more than $250,000 in an account just to meet payroll. But anyway, so the stress tests are good and they're gone. Again, I don't think they're a huge deal, but now they're one less thing to worry about, if that answers the question.
Yeah, absolutely. I think one highlight I wrote down or highlighted with a marker was credit card debt. Seems to be still something they mentioned that. I'm just looking always, maybe it's the German in me. I'm always looking for a potential trigger, the negative, right? Or a canary in the coal mine when something might break. Credit card debt might be one of them. It's like, do you agree? What do you look for?
Yeah, not only do I agree, I will underscore that and put an exclamation point. I think, and Liz Ann Saunders from Schwab was just on one of the financial stations yesterday, and she put it very eloquently. When she said they at Schwab believe there's rolling recessions already in some pockets of the economy, already in recessions. You mentioned credit card debt. Credit card debt of people from 18 to 25, I believe, is at all-time highs. They're the people who had money and got money through the policies of the last 3.5 years still have money. There was $7 trillion injected into the system. And even though M2 money supply has come back 4.6%, which is historically the biggest percentage decline in M2 money supply, it's still approximately $2 trillion ahead of if you extended the already pretty high slope that began in fall of 2011. If you just extended that increase of M2 money supply, we're still $2 trillion above that based on the $7 trillion that was added. And again, this is a long and roundabout way for me of saying the people who have money still have money. They're not in recession. The people who don't are struggling. And we've seen, they say that inflation ran at 8% for 2 years or whatever the rounded number is. We know that it was more than that. CPI is designed to underestimate inflation for reasons that favors the government.
Yeah. One term I heard last week, and it's disappeared from the media again, is we're going to tap the boomers. Right? Meaning we're going to stimulate the boomers into sort of spending and trying to fill the gaps where possible. There's like, does that make even any sense? I think it quickly came and it disappeared. So, because people just dismissed it. So,
yeah, it's funny to me. It doesn't make a lot of sense. And I think I am a boomer. Some people define it as 1965 being born, and some say 1964. So technically, I am a boomer. And I feel like they've been trying to tap me for quite some time now, if that helps.
Yeah. No, they want you to go out and spend it because you generate some life savings. They want you to spend it all before, pass the buck on, right? So
I'd rather they do that than just take it away from me.
Or just tax it, right? When you the inheritance tax, don't get me started, right? Mind-blowing stuff. Another thing that's been puzzling, and let's go maybe through some of the indicators as well, like housing sales or actually new built permits have shot up last month. Is that just a seasonality adjusted thing? Like it may, whether it's getting better, why is the economy so resilient is maybe the overall question I'm trying to ask.
I think the housing sector is fascinating. And I think it's a lot of it is that think of the fact that they went from 2.5% mortgage rates to 7% mortgage rates in the blink of an eye. I think if that had been graduated and that happened over several years instead of over 6 months, we would have seen somewhat more of a decline in housing prices. However, what they've done, it's like the mortgage handcuffs they've put on the holders of these 2.5% mortgages who will be holding on to them like grim death and won't part with them. And people who were going to move now refuse to. And I think that's choked the supply. Now, add that onto the fact that supply was already running at a deficit since the great financial crisis. So I think the supply issues in housing have surfaced, and that's pushing up prices, particularly in high-end areas and in desirable areas. I think remember that they raise interest rates and they expect real estate to start coming down because they'll do a math equation. Well, this house now costs this amount compared to an interest rate of 2.5%. That's not how it works. Crummy areas that people don't want that are not in high demand lose more. Now we're seeing places like where I have a home in Colorado. It just amazes me the appreciation that still keeps happening today as my neighbors are pricing their places. But as time moves on, life happens, deaths, divorces, things that people do have to part with those mortgages. So it could begin to weigh on things soon. But right now it's served to actually prop up prices in highly desirable areas, which I think is fascinating.
Absolutely. We're seeing a massively bifurcated market because commercial real estate I put right next to credit card debt right now in terms of like default risk, pretty much, just for lack of a better term.
No doubt.
How do you rank commercial real estate? I see the news like companies are giving back hotels and even top-notch area formerly top-notch areas, downtown San Francisco, right? I've been there. It's oh my goodness. I've traveled so many times to San Francisco. It's such a disaster to see. But
Yeah.
besides the point, but commercial real estate is a big one, right? I see
Yes.
Airbnb rental rates now dropping as well. Occupancy is dropping. Commercial real estate in that regard. Like, how do you rank that?
So we can't go through something we went through over the last 3 years and not bear scars forever. And commercial real estate is going to be one of them. Like even, I have two professional daughters and I meet a lot of really high end young kids and they demand work from home now. So automatically need for commercial real estate, need for office space in major cities is just down to 60% it was, even if 100% of the people came back to those places because they're going to demand 2 days working from home to begin with. That's changing a little bit, but not very fast. I mean, my daughter's new job, she's still working at home 2 days a week. I think that has changed, and that's going to be decades long in the making, building it back up again. I think we're going to see a tremendous amount of commercial real estate being changed into residential. And again, what's really fascinating to me too, and I remember when tech started coming around 30 years ago and guys like Bill Gates and guys like Steve Jobs came out and said, yeah, there's not going to be any need for these big cities because people can work wherever they want. So they're going to work in the tranquil peace of the suburbs and the rural areas. That didn't happen because young people, particularly young professional people, want to be together. That's where the entertainment is. That's where the Taylor Swift concerts are. So I could actually see cities becoming more of a place that people live and work from wherever the hell they want. And I think that we're seeing that move, and I think that's really interesting to me as well.
Yeah, that workcation trend is picking up. Definitely, I'm being bombarded on Instagram with workcation ads, for example. Maybe because I'm looking for them as well, but it's an interesting trend for sure.
Yeah.
Jim, we got to talk about the U.S. dollar as well because I think the commodity prices hinge a lot on the U.S. dollar in general. As I said before, like the U.S. dollar start is where it ended the year pretty much, the same level, 103 roughly. Why is it hanging in there? Shouldn't it be much weaker? Debt ceiling discussion, throw that in there, or why isn't it much stronger? When we met in October in New Orleans, the dollar or the Dixie was at 114.
Mhm. And so the thing now is that, and all these calls for the dollar to be replaced as the world's reserve currency don't take into account the fact that every other central bank is just as poor stewards with their own fiat currencies as we are with ours. So you look, and we, by the way, were the first and kind of took charge of the whole fighting inflation thing before others did. One of the only other 2-year yields that's fairly close to us is Canada, but most of the European Union still has much lower 2-year yields, and there's some still inflation. The UK is what I'm pointing to, obviously, that they are going to have to deal with. So we stepped out and started raising rates first. That's supportive of the dollar. That is an excellent thing. Some bad things have happened to the dollar too. When the war in Ukraine began, remember we froze assets of Russian oligarchs and Russia throughout the world. That's not something that's looked fondly upon if you're the arbiter of the world's trade and your dollar is the commodity. So that belongs on the negative side of the ledger as we're putting those together. But that being said, who will you trust to be the arbiter, to have your reserves in, the dollar or the Chinese yuan? And I think the answer to that is pretty clear. We might not be the most dependable country in the world, but we're a spell more dependable than most of the others, particularly in China. So I'm not worried about the dollar losing its reserve currency status. I'm not worried about hyperinflation that I was before, because it does seem like they've taken things seriously in the last year and a half. I will even argue almost maybe too seriously with raising rates. I am still, overall, let's say 10 years ago, I believe the chance of a hyperinflation currency situation, which I believe is one of the worst types of financial crises, is hyperinflation. That's in Caracas, Venezuela. That's when feral cats and rat population went away because they were used as a food source because people couldn't afford it. I'm not trying to be funny. This is just what happens in those things. So 10 years ago, I put that possibility to 0.01% chance. I think the chance of us getting into a situation where we hyperinflate and our currency becomes something that's not desirable has grown to 3 to 5% chance. Sounds low when people hear it from the outside, but that is ridiculous. When we have the world's reserve currency, all we have to do is not mess it up. And then we have these people come out and pitch things like modern monetary theory, which is the height of absurdity. And I think longer term, there are people who genuinely believe we can borrow and spend as much as we want, and it's not going to affect our currency because other countries are doing it as well. That works right up until the moment it doesn't. So the short answer is that I'm not surprised that the dollar's hung in there, because I believe it's a world of poor stewards and bad central bankers. I've come so much around. I don't even think central banks can possibly succeed anymore. I think the tools they have don't work. And and to tell a politician that, oh, because you own the printing presses, you can borrow and spend as much as you want, is literally like lighting a fuse, in my opinion.
Yeah, I think the Fed needs to stop, or the central banks in general need to stop playing a popularity contest here, right? And
Yes.
it's not their job to keep everybody happy. It's their job, to keep inflation at check, unemployment rate in check, and make sure it all works, right? Even if
Right.
it
It should be
means,
a formulaic based. But that also presupposes that the CPI can genuinely measure inflation. Remember, in my investing lifetime, there was inflation in tech stocks that no government measure picked up. There was a inflation in real estate that no government measure really picked up, should have. So it's a very complicated question. But if we can come up with a rules-based system with liquidity in the market where the Fed has to tighten certain times and doesn't have to worry about what people think, we shouldn't even know central bankers' first names. They should not be on the cover of Newsweek. They should not be popular people. If they were doing their jobs quietly, it would be a lot better system.
absolutely, yeah. I would just keep following Jerome Powell like he's the next superstar, right? And just can't wait for his next talk. He was just speaking yesterday on Bloomberg, and I was texting a friend. I'm just as excited as watching a football game. Who knows what he's going to say, because it's going to trigger something, right? So, Jim? Oh,
Yeah, now I'm
okay.
back. I'm
Okay.
sorry about
Yeah,
that.
froze for a second, right? But
Yeah.
that brings me to the next question, sort of leading to it. Japanese sort of what's the word I'm looking for? That's a language barrier thing. It's just sort of like the U.S. might turn into Japan on a debt to GDP level, but that would mean the Fed would have to buy T-bills. Okay,
Right.
directly from the government. So that brings me sort of to the T-bills issuance that I've mentioned in my intro. We need to talk about that, because it's $1.1 trillion, fairly short-dated treasury bills, meaning ultra-high yielding, meaning 5% plus, unless it's 2 years, about 4.83 or something right now. But I'm again, canary in the coal mine. I'm looking for leading indicators that things might break. How do you see things going? Buzzword here maybe is liquidity as well.
Right. So liquidity. So I already mentioned once, M2 money supply coming off 4.6%, which is the highest in history. I had to lay out why I am short-term bearish the equity markets a couple of days ago in something I wrote. Number one is Jay Powell continuing to talk about tightening and probably actually tightening. Number two is, like you said, you have to remember, since January, when the debt ceiling stalemate happened, the Treasury let its account run down at the Fed, wasn't issuing as much, and still kept spending the same amount. That was adding liquidity to the system. Now, as we reverse that, the Fed has to build back that account. So what they're doing is selling treasuries, like you said, and still spending the same amount. Normally, selling treasuries is counterbalanced by increased spending. So it's not necessarily pulling liquidity from the system. In this case, it's pulling reserves from the banks who have to buy these treasuries. So it's pulling it back. So now there's two things that are pulling out liquidity: the Fed raising rates, quantitative tightening, and then the Treasury building back up its reserve account. So these things are a very big deal. Now you want to throw in the fact that we're about to resume payments on student loans. And I think this is a minor deal, but it does kind of underscore kind of the cacophony of errors that can happen from this federal government. Like when demand was huge and inflation was skyrocketing and they still had forbearance of student loans, that was irresponsible. Now demand is falling. We're seeing some of the cracks. Now they're going to choose the time to stop the forbearance loans and resume payments. So they're going to be zapping liquidity out of the system just at a time when perhaps this waiting for Godot recession, like you said, is probably beginning to happen. So that's one of the reasons. Again, one of the themes that's kind of happened on the show right now is saying that the tools that the government has and the Fed have, not one, are not that effective, and two, they don't use them at the right time. So those are three things that could be pulling liquidity out of the system soon. So I think that equity markets could suffer over the next month. But then, of course, I think the Fed's will flip.
Yeah, interesting. Like what we just talked about, like the pendulum always swings in to both sides, and usually equally as drastic. So deflationary shock is a word that just came to mind as well. So if we drain as much liquidity as we just discussed, it's going to language today. Apologies, but I'm missing words here. But it's just going to drain that liquidity. It's just going to cause people to spend less, like reduce purchasing power, meaning businesses will have to reduce prices to entice buyers, causing deflation. Right? Is that
So to put a point on that, is 4 times in our nation's history has M2 money supply come down by more than 2%. 3 of those times were a depression. The 4th time was in 1893, where it was a bank crisis. It was almost a depression, but not quite. It's always been a big deal when liquidity is out of the system. Now, that being said, what I said before is that this 4.6% decline, which is probably going to continue further, looks eye-popping and alarming. But when you juxtapose it against the fact that we injected so much money into the system over the last 3 years, it's probably just somewhat of a mean reversion type of trade more than anything else. So I'm worried about it, but not like if you just took those numbers in a vacuum saying, holy crap, it's off. M2 money supply is down 4.6%. This means we're falling into a depression. That's not what I believe right now. I believe that it's just more of a mean reversion of M2 money supply. I think you are right on the head when you say liquidity is a huge issue, but I still think there's excess liquidity in the market that needs to be drained. I just hope they drain it slowly, because anytime they try to do anything fast, they just end up causing disruptions and dislocations.
Well, that's what Powell wants, right? He wants to cause pain. Wasn't that what he said 12 months ago or so?
Yeah, and he also says things like wants to create slack in the labor market, and like he doesn't realize, like to him it's something on a whiteboard. The reality of it is he's talking about you losing your job. Yeah. Like it's just they say it so casually, cavalier, and they think they're playing God, and they've distanced themselves from the realities on the ground. It's like that ivory tower thing, and they're just looking at the flames. They don't even notice anything until the flames get to their window. There's real people that suffer from bad economic policy and bad Fed policy.
Absolutely. Let's swing back to commodities here. You mentioned that you own quite a bit of gold, silver, and copper as well. Let's start with copper. You said you were uncomfortably long in December. Price performance, great. It went up roughly 10%, 15% since then, but it came back down. We're pretty much again at the same price as we were back then. Has your thesis changed? Has the premise changed at all?
My long-term thesis has not changed. Remember, it was a trade and it was an investment. And that's the way I package it. I still believe that. I think if copper trades below, call it 3.5, the futures contract, which it's kind of flirting with, I might lighten up on some of that position in the short term and thinking that technically it looks lower. But I think the fundamental story for copper is still good, but it needs a little bit more of an accommodative Fed. So the question becomes, when's that going to come? It doesn't seem like it's any time on the near-term horizon right now, but other things are still working in its favor. We still have people in office, not just in our country, but around the world, who are pushing the decarbonization agenda. That requires copper. We're still at a deficit in copper. If they're going to accomplish the goals they need, we are going to need a ton more copper. Some of that comes from mining, some of that comes from recycling, but all those things should push the price of copper higher. So I'm still going to stay long. Again, none of these trades are going to work if the Fed keeps tightening for the next 2 quarters and nothing happens. Then there's going to be pain on them. 2s versus 10s, as we said before, said that, still says the recession is coming. The fact that the 2s versus 10s is negative 103, everyone says that 2s versus 10s is a great harbinger, a great predictor of recession, and it is. The recession tends to come about 18 months later. The depth of the inversion does not correspond to the depth of the recession, but it does correspond with the how certain we are that it's going to come. So there's never been a inversion of this. Well, there's never been quite an inversion this steep where the recession didn't come, and I don't think this is going to be the first.
Yeah. One of the reasons you mentioned copper as well was the China reopening post the zero COVID policy days here, and that sort of disappointed overall, not just on the copper side, but that reopening theory sort of just lagged behind. But now I'm seeing numbers that the Chinese GDP is going to outpace the US GDP over the coming months here as well. Like, is the story renewed? Are we, is that picking up steam again?
Fool me. What is it? Once bit and twice shy. So yeah, it turns out when the China reopened, I did expect more from that. I expected more.
I think everybody did.
I think everyone did too. So it turns out that if you intermittently or pretty much lock down your economy for 2.5 years, you can't bounce out of it that quickly. Who would have known? In retrospect, we all should have known. So the reality is they've started to stimulate and they've started to inject liquidity. I do now believe that they are going to start to gather some momentum. And I think that bodes well for the copper trade too. But again, like I said, I thought this once before and got slapped. So I'm hoping this works. And by the way, when I say the word hope, I get about 100 people saying hope is not a strategy. Sure, hope's a strategy. It's not a very good one.
Makes sense. Makes sense. Jim, it's great conversation so far. Let's wrap up with gold and silver. Again, gold is actually not doing too bad, given everything, because the Fed keeps pulling the rug on us. Chairman Powell just dangling the carrot of future rate hikes and no end in sight, putting massive pressure on it. Where do you see gold heading in the next few months? Because right now sentiment is pretty bleak.
So today, gold bounced pretty well off that 1900 level. I can't believe it's at 1900. And again, it's been a little bit painful to me, but it responded very well to that. Bitcoin has been going through the roof. The Bitcoin gold ratio is at the highest level Bitcoin that's been in many, many months, which I think is interesting because those things, in my opinion, should trade together, but it ends up Bitcoin trades more with the Nasdaq than it does with gold. So it's very kind of confusing me. So let's just talk about gold. The gold story needs some bad economic data coming. The gold story needs Jay Powell to take a back seat. We are going to take a lot of heat. I'm going to take a lot of heat on this trade, probably until that happens. I believe we could be weeks away from seeing a noticeable change in the economic data that starts to suggest the waiting for Godot recession is actually happening. The labor numbers we have seen, I think, are kind of a big, almost a head fake. They make it seem like things are good in the labor market, and I think it's covering up some deterioration. The JOLTS number, I think, is nonsense. I think people just leave job openings in the JOLTS thing and forget to take them down. So I don't think that's anything to take any comfort from. Until today, jobless claims had been going up higher for the last few months. Today it ticked down a little bit too. But I think the next time we see the unemployment data, which is that going to be the 7th, right? 7th, I think, is the unemployment data. And I think it's going to be an enormous day because we know now that inflation is coming lower. And it's nice. Tomorrow we have PCE, which is a big deal too. But as long as inflation stays a little bit tame, if we see some bad news on the job front next Friday, I think that's potentially when the move in gold could happen. And technically speaking, it bounced off that 1900 level today. And I think that's a good sign, but it's not, I need fundamental confirmation before I increase my positioning in that.
Absolutely. How about silver? Just gold's little brother. We have to talk about just trading in tandem.
Yeah, trading in tandem. So that's why I actually had memorized the gold levels I was looking at too. I still have my silver position on. They've mostly been trading in tandem with, so I wasn't really looking at the levels that hard. The story for silver is the same, and the story for silver too has to kind of almost bleed into the copper arena as well, where not only do we need loose money policies for silver to outperform, we need a belief that those loose money policies are going to spur on economic activity too. Because in my mind, I always picture like silver is like 70% of a precious, 25 to 30% of an industrial. It is used for things. So I think that if we have those two things, silver could do very, very well. But I'm looking at gold more closely for the trade.
Fantastic, Jim. Phenomenal conversation. Lots of action packed into the last 27 minutes here. Where can we find more of you, Jim?
So at Jim Iuorio on Twitter, that's JIMIUORIO. I like to stir it up. I like discussions, and I like when people disagree with me. So please feel free, and if I have time, I love to engage. The Futures Edge podcast, which has been a ton of fun. You can find that on Spotify, YouTube, Apple, iTunes.
We'll link to it below as well. So
thank you very much. I appreciate that. But anytime you guys reach out, we'll talk. I know it comes through. I like to talk.
Fantastic, Jim. I tremendously enjoyed the conversation. Again, thanks so much for your time. Everybody else, thank you so much for tuning in. We hope you enjoyed this conversation here on Soar Financially with Jim Iuorio, and he's been doing fantastically well. Like, we covered a ton of information in this 27 minutes. If you haven't done so yet, please subscribe here. I keep messing it up. It's right here. There's a subscribe button. Hit that subscribe button. It helps us tremendously, bringing guests on, and even continue bringing guests like Jim on the program. It helps us. Thank you so much for that, and we'll be back with lots more content. We have some great guests coming up. Jim Rogers, just to name one. Thank you so much. We'll be back.